Dear Intopia teams, welcome to our first tutorial on reading an Intopia company report. This first tutorial will address the assets, the first part of the balance sheet, which is composed of assets, and then liabilities and stockholder equity. What is a balance sheet? A balance sheet is essentially a snapshot of a company's wealth at the end of a given period. So what we see here is what the company owns, which are the assets. It owns assets. And then the other side is what it owes. It owes money to companies and other investors that have lent money. These are listed in the liability. And it also owes money to the shareholders who have invested, have put risk money into this venture in the hope of getting an adequate return. So assets is the first side that we are going to discuss in this particular tutorial. Assets are listed by decreasing level of liquidity. The first thing is cash, because cash is very liquid. It means liquidity is something that can be spent in the very short term. If I have cash, these are exactly the means of payment that I can use tomorrow or even actually right now. Then will be account receivable. Account receivable are money that other players, other organizations owe me. These are amounts that will be paid to me in this case because we are in period 8, Q8. In this case, account receivable period 9 is the amount that, for instance, clients will pay me in the following period. We also have account receivable 10, which are payments that are going to be made to me in 2 quarters. So that's a little bit less liquid than cash, but I can count that in 2 quarters, at least, I will be able to spend all this amount. Then come the inventory, the value of inventory, which is categorized by product and grade. Standard chip comes first, then deluxe chip, standard PC, and then deluxe PC. And then one particular line is the total, which is the total of all inventories broken down on the left column. Then comes government securities. Government securities are bonds, government bonds that I have purchased in the past and that can be sold. So that has a maturity of 1 quarter actually. So it's very close to liquidity. And then come a total called total current assets, which is the sum of all assets until that point, which are considered relatively liquid, and that's why they're called current. Then we go to fixed assets that are composed of the factory, the value of the factory and equipment. In this case, 1,170,000. Intercompany investment and hedge. If you have lent money to another company, it would come here. And then subsidiary control is something we come to later when I talk about the headquarters. And the sum of the fixed assets and the current assets will be, of course, total assets. We have the same structure for all operational or operating units, US, Europe, and Brazil. The home office is a little bit of a different story because it has no inventory, no account receivable. It may have securities. It may have subsidiary control. It may have intercompany investment. Because intercompany investment actually is always from headquarter to headquarter. Now, what is subsidiary control? Subsidiary control is the value of the investment made by the Home Office into the different subsidiaries. When I set up operation in the US, I send money so that the subsidiary there can buy inventory, a factory, sales offices, whatever. This money that I send is like the local equity, the equity of the local subsidiary. The value of this equity in the various region is owned by the Home Office, and that is what is called subsidiary control. So we have then a particular, a special, you could say, list of assets in the Home Office because it has a few items that do not exist in other areas. Then the last column is called consolidated. What is consolidated? Consolidated is really an accounting evaluation of assets in the various areas, evaluated into Swiss francs, because as you know, all your companies are registered in Liechtenstein, and their equity is in Swiss francs, and therefore when we want to look at their financial situation, we need to put everything into the Swiss francs currency. So for instance, if we see here 3,323,000 Swiss francs worth of cash, this is the sum of the different cash position in all the areas, including the Home Office, and they are re-evaluated into Swiss francs to make this amount. So this is not a real amount of cash, actually. It is the value of all the cash in all currencies in all areas owned by this company. The same goes for account receivable, for inventory, for current assets, for everything. And then we come to the total assets of this company.